You sign a loan agreement. Nothing dramatic happens. No truck arrives with cash, no vault opens, no printer starts humming. And yet, money has just appeared. Not metaphorically, not eventually, right now. That uncomfortable truth is where this story starts, because most people believe money is created by governments, or central banks, or maybe some distant authority with power you'll never touch. But when you take a loan, the real creator of that money is much closer. Closer than the bank building, closer than the ATM. And once you see how it actually works, it's very hard to unsee. This matters right now because debt isn't a side topic anymore. It's the system. Household debt, corporate debt, government debt. All of it has exploded over the last few decades. And yet, very few people can clearly answer a simple question. Where does the money come from? Let's slow this down and strip it of jargon. Imagine you walk into a bank and ask for a loan, say $100,000. You might picture the bank checking a vault, or borrowing from someone else, or using deposits from other customers. That's not what happens. The bank checks something else first. You, your income, your credit history, your likelihood of paying it back. If you pass, the bank doesn't give you existing money. It creates new money on a computer. Your account balance goes up by $100,000. At the exact same moment, a loan asset appears on the bank's balance sheet. 2 entries, 1 click. No one else's money was moved. Nothing was taken from a pile. The money did not exist 5 seconds ago. Now it does. This is the part that makes people uncomfortable. Commercial banks are allowed to create money, legally, routinely, at massive scale. Central banks don't create most of the money you use. Governments don't either. Loans do. In modern economies, the majority of money exists because someone somewhere is in debt. That's not a metaphor. That's the structure. Here's the simple version. Every loan creates new money. Every repayment destroys money. When you pay back the principal of your loan, that money disappears. It doesn't go back into circulation. It's erased from the system. Only the interest remains as bank income. So the system requires something very specific to keep going. More loans, bigger loans, constant expansion. This is where the quiet tension starts. Because money is not created by productivity first. It's created by permission. Permission to borrow. Permission to expand balance sheets. Permission to believe the future will be bigger than the present. For decades, this worked beautifully. Homes went up, stocks went up, consumption went up. Debt was framed as opportunity, leverage as intelligence. But under the surface, something strange was happening. The money supply was growing faster than real value. Assets inflated faster than wages. Financial wealth detached from lived reality. And the system learned to depend on it. Here's the irony. Banks don't lend because they have money. They lend because they believe you can pay, which means money is created based on expectations about the future, future income, future growth, future stability. The entire system quietly bets on tomorrow being better today. That's fine, until tomorrow starts looking smaller. Now zoom out. When millions of people and companies borrow at the same time, money floods the economy. Prices rise, assets surge, everything feels liquid. But when borrowing slows, the opposite happens. Money stops being created. Repayments continue. Liquidity dries up. That's when things break. This is why financial crises feel sudden. The system doesn't gradually slow down. It flips. What looks like a credit crunch is actually a money disappearance event. Loans aren't being created fast enough to replace the money being destroyed. And because money and debt are the same thing in different clothing, panic spreads fast. Now here's the part most people never hear. Central banks don't directly control this process. They influence it. Interest rates, liquidity facilities, regulations. But commercial banks decide when money is created. That's why lowering rates doesn't always work. If banks don't want to lend, money doesn't appear. If borrowers don't want debt, the machine stalls. This is also why asset markets react before the real economy. Markets are sensitive to credit. They feel the tightening first. By the time job losses show up, the money has already stopped flowing. There's a quiet absurdity here. We're taught that money is scarce, that it must be saved, that it represents value earned. But the system runs on something else entirely: confidence, risk tolerance, and collective belief in growth. Money is created not when value exists, but when value is expected. That gap is where bubbles form. And here's the uncomfortable math. Because interest is not created with the loan, only the principal is, which means system-wide, more money must be created in the future to pay existing interest. Debt requires future debt. That doesn't mean collapse is guaranteed, but it does mean stability depends on constant expansion. When growth slows, pressure builds. When growth stops, defaults appear. When defaults spread, money vanishes. This is why governments step in, not to save banks in some abstract moral sense, but to prevent money from disappearing too fast. Bailouts aren't charity, they're damage control for a system built on credit. Printing money isn't printing money, it's replacing destroyed money. Now contrast this with the story we're usually told, that banks are intermediaries, that they connect savers with borrowers, that deposits fund loans. That story feels comforting. It's also outdated. In reality, deposits often come after loans, not before. The loan creates the deposit, which means your savings are often someone else's debt indirectly. That's not sinister, but it is fragile, and it explains something people feel but can't quite name. Why the economy feels increasingly financialized, why asset owners pull ahead, why stability depends on ever cheaper credit. The system rewards those closest to money creation. Borrow early, borrow big, borrow cheaply. Everyone else gets what's left. Now zoom even further out. Globally, the same logic applies. Countries that control reserve currencies can run larger debt without immediate consequences. Others can't, not because of morality, but because of trust. Trust determines who can create money safely and who can't. This is why debt crises are political events disguised as financial ones, and why sound money arguments miss the point. The question isn't whether money should be created, it's who gets to create it, under what conditions, and for whose benefit. When you take a loan, you're not just borrowing money, you're participating in the core mechanism of the modern economy. You're helping decide where new money enters the system: housing, consumption, speculation, investment. Every loan is a vote, and most people never realize they're voting. So here's the unresolved part. If money is created through debt, and debt requires growth, and growth is slowing, what happens next? Do we redesign the system? Do we socialize money creation? Do we accept higher instability as the price of flexibility? Or do we keep pretending money comes from somewhere else? That's the real question hiding behind your loan agreement. And once you've seen it, you'll never look at your bank balance the same way again.